This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hi, I'm Louis Llanes with WealthNet Investments, and today I'm going to be talking about the importance of having an edge and using setups. And the reason why I wanted to talk about this is because a lot of people feel like when they're investing or when they're trading in particular, that they don't necessarily have a strategy that is defined. And I think the number one thing that people lack when they're really turning from being kind of an amateur to being a real pro at making returns is having a good setup strategy. And it doesn't have to be just one setup. It could be many different setups, but it's a disciplined way of finding an entry point. So let me explain the concept of a setup. A setup is basically what are those preconditions that need to exist before you're going to enter a trade or an investment. And that means what are the pre-qualifications before you will even consider something to trade, and what are the reasons why, and the reason why you have an edge. The edge is basically a simple definition. The edge is when you have a higher probability of one thing happening over another. So for example, if you have a higher probability that a stock that has strong relative strength is going to outperform the market over the next 1 month, 3 months, 6 months, a year, that's an edge. That tells you that, hey, maybe not every single time a stock has strong relative strength will it outperform, but the weight of the evidence and the probabilities are that you will outperform, and the data shows that. And one of the things that you want to see with any edge that you develop, any kind of factor that you develop, you want to have a factor that is based on logic as well. And the reason why is you want that logic to actually be something that can explain why this should continue to exist in the future. Because there's a thing called spurious correlation where you can have certain things just kind of correspond to better returns, but in reality, it's just by chance. It's not a real reason there for that to exist. So we want to have an edge based on logic as well as rooted in statistics. So when we have an edge, it basically gives us it's almost like playing poker. So you can have somebody who plays poker who is just, plays casually and kind of knows how to play, or you can have somebody who is a real pro who knows the odds and who bets in according to the odds and who also knows when to hold them and when to fold them. And that's exactly what all investment managers and specifically traders need to do. So I want to talk a little bit about time frame here and the word investor versus trader before we go any further. A lot of times people get confused between the two. We're just trying to make money in the markets, right? An investor, a lot of times people think, well, I'm an investor, so that means I'm going to hold things for a long period of time, and I'm going to let them play out based on the fundamentals, the revenues and the business that they own. So that would be kind of a long-term investor. So in the context in how I'm speaking here, this applies to both that long-term investor as well as the trader. Now, a lot of people think that trading is a lose-lose situation and that people cannot make money trading. I happen to know 100% that is not true. Trading is viable, and if you know what you're doing, you can make tremendous returns trading. There are companies that just trade. There are individual investors. There are hedge funds that just trade, and they do not look at fundamentals in any way. So, and the reason why I'm bringing that up is because I want this to, be known that this is applicable to both trading and investing. Edge and also having a strong setup. So let's talk a little bit about setup now, just to kind of go back to that. The reason why I brought up the concept of a setup is because many times when people are investing or in trading, they basically have a hard time going from being kind of a novice to being a real pro, because they don't have the setups. They don't know those criteria that they're consistently looking for and that they're acting on. So that is the key. You have to have a set of constraints or a set of conditions that must exist that generate future edges. So, or an edge that you will probably do better, whether it be to buy or to sell. So some of the most common edges that I've used this week, for example, in my trading in our proprietary account, as well as with individual accounts for clients, would be relative strength. That's the simplest one you can use. Relative strength is basically comparing the return of a stock, for example, relative to the stock market. So historically, when stocks that are performing better than the stock market over intermediate term timeframes, they tend to outperform stocks in the future timeframes. So that's one part of kind of a trend template or a trend setup where you want to say, hey, this stock is outperforming the overall stock market, and it may have another pattern such as volatility contraction. So for example, we know that when volatility tends to decrease, then you tend to have an expand in volatility in the future. And if you have a company that has a strong uptrend and better relative strength compared to the market, and it is currently contracting in volatility, meaning that it was trading really wide for a while and now it's trading narrower and narrower, there's a higher probability that that stock will continue its uptrend and you will have a more explosive type of a move. That would be a concept of a setup. So you could systematically go through companies and scour the S&P 1500, for example, and look for companies that have better relative strength, stronger absolute trend, meaning, if the market is going down and it outperforms, it doesn't matter. We want to see real strength, either way. So let's say absolute strength and relative strength is positive, and we have some form of volatility contraction. And we also know that, for example, lower volume tends to lead to better performance, which is really the opposite of what people think. But in general, there's some studies that we've done that shows that when volatility is actually lighter than normal on a monthly basis, that you tend to have more volume in the future. And a lot of times when big moves occur, they occur on big volume. You don't want to buy after the big volume has already occurred. You want to actually buy the setup, in this example, when volume is contracting. So we have volatility contracting, we have volume contracting, and we also have a strong relative performance. That would be an example of a setup in stocks, for example. And then you have the entry, the actual point when you get in. That's another element of really the differentiation between somebody who's kind of a okay investor or trader and somebody who's a real pro, is not only will they have a setup, but they'll also have that trigger point where they know now is the time for me to act. And you can have a great setup, but if you don't actually act on the setup when it occurs, it doesn't really do you any good. You have to decisively act. And really the only way you can get to the point where this really helps you profit is when you've done your research and you know that the probabilities are in your favor. You have a very high chance that they're in your favor based on your research. And that gives you the confidence to move forward, because you can't get anywhere without the confidence to actually pull the trigger. Now, the last element of the edge that I think is a big part that I want to mention is predefining risk. One big differentiator between somebody who is a kind of okay trader or investor and somebody who's like a crazy great investor is they predefine their risk and they position size. They determine how much they're going to put into that based on their predefined risk. So if you don't go into an investment or a trade knowing what your uncle point is, when you're going to say, look, this does not make sense for me, then you really are running blind, because you're just kind of just letting the market tell you what what you do. In actuality, in order to do a good job, you have to be in control the most that you can. There's only some things that you can control. You can control what you invest in. You can control how much you invest in. You can control the speed, your time frame. You can control your diversification, but you can't control what the market is going to do. So you have to actually just let go. Once you've actually done, it's like playing a card bet. Once you work the odds and then you let go, because you know over time it's going to work. But any individual trade or any individual investment that you have may not be a positive outcome, but over time your edge will show its way through your performance. That's the difference between a pro and an amateur. Okay, that's it for setups right now. We can dive into this in so many different ways, but I just thought just a quick video on setups and having your predefined risk and an entry, how important that is to make the difference between being okay and being really great. Louis Llanes with WealthNet Investments and Llanes Research. Thank you so much for joining me today, and happy trading and investing.
If you like this information, be sure to subscribe and follow us on Twitter and Facebook. The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals.